So before we start looking for low risk, high reward trades, which would be your swing trades, we need to understand what a daily candle is and how prices deliver through your daily candle. Here you have a bearish candle. Here you have a bullish candle. Here you have your candle open, which would be your daily open. Here you have your daily high. And here you have your daily low, which would be your close. So here you have your daily bullish candle. So this is how this candle translates in micro price action. As you can see here, you have your daily open, you have your daily low, which would be your wick, then you have your expansion, which is the body of your candle. So the way to trade this, what you want to look at is, let's say you can anticipate your next candle to be bullish. So you have a bearish candle, you have a bullish candle, and you're anticipating your next candle to be bullish. So to take advantage of that bullish range, what you would want to do is first of all, you would want to mark your open. So your open would be your previous day's close, which would be your new day's open. So here you have your open. So what you would want price to do is obviously be under your open. Why under your open? Because you're strictly focusing on trading the wick. You're trying to get in at the lowest position you can for the highest reward. So you would want an accumulation to happen underneath your daily open, which is forming your wick. And you would want to see liquidity being built for price to take that liquidity, stop hunt it, and expand to give you another bullish candle. And your entry is within your manipulation. So let's go over this. So here you have on a daily time frame, price is rejecting from your daily range extreme. And you've seen a reaction. The confirming reaction was the bullish candle. So now that we know that probability wise, we're anticipating our next candle to be bullish. So what's our next step? We mark our daily close. So once we mark our daily close, we go to the lower time frame, understanding that our daily close is the next day's candle open. So now what we're waiting for is accumulation being built up, a stop hunt to take out the liquidity, and an expansion. So here you have your accumulation being built. So now that you have your liquidity, what are we waiting for? We are waiting for a stop hunt to take the liquidity and expand the opposite direction. This is classic AMD, accumulation, manipulation, distribution. And that's what happened. And the result of this trade, a lot of times, is price going from an extreme to an extreme. So price, you can take your first take profit at the range extreme here, or you can take it post extreme. And this gives you an extreme high risk to reward, almost 15 to 1. This trade is if price forms your accumulation above your open. So if price forms your accumulation above your daily open, then more than likely price will not stop hunt and come back to expand. Price will more than likely go the opposite direction. So the point of this is you want to trade in your wick. So this entire motion here, it must happen. This entire motion here must happen underneath your daily open. Why underneath? Because you want that wick to form. When that wick forms, you can get in the wick to take advantage of the entire expansion. So another way to trade the daily wick is to look for a unmitigated order block. So here we have a daily bullish candle. We can anticipate the next candle to be bullish. Why? And I covered this in previous lessons. That's why we're not wasting time covering it. But here you have a range break where price broke the range, broke structure, and came back inside of the range. So what happens when price closes below the range and comes back inside of the range? More than likely, price is seeking internal liquidity, which would be somewhere in the extreme zone here. Where you see these rejections, price is more than likely targeting this area. So now that we know probability-wise the next candle should be bullish, what do we do? Of course, mark your open, your next day open, which is your previous day close. Once you do that, you go on the micro time frames. So your two options here is you would look for a unmitigated order block, which we will cover in a second. And the other option, of course, is you would wait for your accumulation, a clear accumulation. It can be a almost an accumulation or partially accumulation. You want a perfect looking accumulation where the liquidity is built, and for price to take that liquidity, and you will get in a trade once price comes back inside of the range here, because you would anticipate the expansion, with your stop loss being extremely low, somewhere around 5 to 6 points, and your TP would be anywhere from 100 to 200 points. And another option is you would want to look for a unmitigated order block. So now we start looking. We have a order block here that's unmitigated. Here we have an order block that's been mitigated already. And here you have another unmitigated order block. So now it comes down to which order block are you going to choose? Which one makes more sense for you? A lot of times what you want to start off is you would want to disqualify a unmitigated order block first. So the way to disqualify it is you would look at this order block here, and this order block did not cause a strong reaction that broke structure. Now, if this OB was responsible to break this structure without any major pullbacks and showed enough strength, a pullback to this order block would make sense. But the fact that we didn't see an aggressive movement, and we covered how to validate order blocks on our website, but if there was significant strength coming from this order block to push price through, this would be valid. But the fact that this is not a valid unmitigated order block, we would look at the next one. So your other option now is your extreme order block, which would be this one. It will be the safest. Your stop loss will be the smallest, and the reaction from this order block, this extreme order block, broke structure, showing sign of strength. That means the buy orders injected right here were strong enough to break structure, break its previous swing high. So now we know we're targeting this order block. And another reason too is you have inducement. What is inducement? A used up OB. So we know that there's liquidity resting right here. And not only that there's an inducement, you had a FTB here, FTB liquidity, which is used up liquidity. So now price is incentivized to break through this level and attack your order block. Why? Because this order block is no longer valid, which formed your fail to break liquidity. Hope you guys enjoyed this video. Make sure you like, share, and subscribe, and make sure you comment. Let us know what lesson do you guys want next.